Vehicle tax deductions can save you thousands of dollars every year, but get them wrong and you could face a nightmare audit that costs you even more. Today we're diving into real court cases where taxpayers lost big. We'll learn from their mistakes so you don't make the same ones. The IRS wins about 74% of all vehicle deduction cases in tax court. That's a scary number. But here's the good news. Once you understand what goes wrong, you can protect yourself. We'll look at actual court cases, see what these taxpayers did wrong, and learn how to do it right. These aren't made up stories. These are real people who lost real money in real courtrooms. Their pain can be your gain if you learn from their mistakes. Chapter 1. The 2 ways to deduct vehicle expenses. Before we jump into the court cases, you need to understand the basics. There are 2 ways to deduct vehicle expenses for your business. Think of them as 2 different paths to the same destination. The first path is the standard mileage rate. This is the simple way. You track your business miles and multiply by the IRS rate. For 2025, it jumps to 70 cents per mile. That's a nice increase that puts more money in your pocket. So if you drove 10,000 business miles in 2025, you deduct $7,000. The standard rate covers everything: gas, oil, repairs, insurance, depreciation. You don't need to track individual expenses, just track your miles. The second path is the actual expense method. This is the complicated way. You track every single car expense: gas, oil, repairs, insurance, depreciation, registration fees, everything that costs money for your car. Then you figure out what percentage of your driving was for business. If you drove 20,000 total miles and 16,000 were for business, that's 80% business use. You deduct 80% of all your car expenses. Here's the critical part most people miss. Your choice in the first year can lock you in forever. If you own your car and choose the actual expense method in year 1, you can never switch to the standard mileage rate for that car. Ever. Now let's see what happens when taxpayers try to claim these deductions without proper records. Spoiler alert, it doesn't end well. Chapter 2. The Craddock Case. When good records go bad. Meet Mr. Craddock. He ran a consulting business and thought he was smart about record keeping. He kept a detailed log of every single mile his truck was driven. Every trip had start dates, end dates, locations, and mileage. It looked comprehensive. It looked professional. Sounds perfect, right? Wrong. The tax court threw out his entire deduction. Here's why. His log recorded every mile the truck was driven, but it didn't separate business miles from personal miles. The court couldn't tell which trips were for business and which were for personal use. That's like giving someone a grocery receipt and asking them to figure out which items were for your restaurant. Imagine reading Craddock's log. Monday, drove to downtown. Tuesday, drove to the suburbs. Wednesday, drove to the mall. Were these business trips or personal trips? Nobody could tell. Not the IRS, not the court, not even Craddock himself. But it gets worse. The court found problems in his log. Numbers didn't add up. Dates were inconsistent. Miles for the same route varied wildly. Once the court loses trust in your records, you're done. They won't try to fix your mistakes for you. Craddock tried to save himself with bank statements. He highlighted gas purchases and toll charges. Look, he said, here's proof I spent money on the truck. But the court said this proved nothing about business purpose. Just because you bought gas doesn't mean the trip was for business. You could have driven to Disneyland. The lesson from Craddock is crystal clear. Your log must clearly show which trips were for business, and it must be accurate. One mistake can destroy your credibility with the court. The court expects perfection, not good intentions. But Craddock's problems were nothing compared to what happened to our next taxpayer. This one will really shock you. Chapter 3. The Kilpatrick Case. Why timing matters. But really quick before I move on, if we haven't met yet, I'm Sean's clone, a licensed tax professional who personally researches and writes every script you see from me. And while Sean is helping people save on taxes, I'm here to share his knowledge with you. But if you have any questions, the real Sean reads every single comment and tries to respond to most. Also, if you need help with tax planning, click the link below to get a free consultation to start saving more money before the tax year ends. Let's continue with Chapter 3. The Kilpatrick Case, Why Timing Matters. Here's a story that will shock you. Mr. Kilpatrick was a CPA, a certified public accountant, someone who should know the tax rules better than anyone, someone who helps other people with their taxes, yet he made a mistake that cost him everything. Kilpatrick got audited for his 2009 vehicle deductions, but he had a problem. He never kept a mileage log during 2009. So in late 2011, 2 years later, he tried to create one. He took a 2009 calendar and circled dates. He printed MapQuest directions to show where he went. Then he presented this to the tax court as his records. The court was not amused. They called his reconstructed records worthless. The law requires records to be made at or near the time of the travel. 2 years later doesn't count. The court said records created for an audit are inherently unreliable. Think about this. A professional tax preparer couldn't convince the court to accept late records. If a CPA can't do it, what chance do regular taxpayers have? The timing rule is absolute. There are no exceptions for busy schedules or good intentions. There are no exceptions for professionals who should know better. If you don't create the records when the trips happen, you lose the deduction, period. Kilpatrick's case is especially painful because he probably did take those business trips, but without contemporaneous records, he couldn't prove it. The court doesn't care what probably happened, they care what you can prove. Our next case shows just how far some taxpayers will go to try to fool the court and how badly it can backfire. Chapter 4, the Ease case, the fake calendar disaster. Mr. Ease thought he could outsmart the system. When the IRS audited him, he created fake calendars and odometer readings. But he made one fatal mistake. He admitted these records were created just for the audit. Ease's story was ridiculous. He claimed he wrote down odometer readings for hundreds of trips on scraps of paper. Then he threw all these scraps away, but somehow he perfectly remembered every trip when creating his audit records. The court didn't buy it for a second. But Easy's fake records had obvious problems. Calendar entries for the same dates in different years were identical. What are the odds you do exactly the same thing on March 15th 2 years in a row? Every business purpose was listed as simply business meetings. No details, no specifics, nothing that would prove these trips actually happened. Real business travel has variety. Some days you visit clients, some days you go to suppliers, some days you attend conferences. Easy's log looked like he did the same thing every single day. That's not how real business works. The court destroyed Easy's credibility. They found his testimony entirely not credible. Once a court decides you're lying, your case is over. No amount of records will save you. No amount of explaining will help. Easy's case teaches us that fake records are worse than no records. At least with no records, you might get sympathy from the court. They might think you're disorganized but honest. With fake records, you get anger. The court thinks you're trying to steal money from the government. But sometimes taxpayers lose even when they're not trying to cheat the system. Sometimes they just don't understand what counts as a business expense. Chapter 5, the Spencer and Schultz cases, missing the business purpose. Let's look at two taxpayers who had expenses but couldn't prove they were actually for business. Their cases show that having receipts isn't enough. You need more than just proof you spent money. Mr. Spencer owned a medical transportation company. He had receipts for vehicle rentals and repairs, real expenses, real money spent. These weren't fake like Eza's records, but he couldn't prove when, where, or why these vehicles were used. No log, no business purpose, no deduction. The court said Spencer failed the most basic test. He couldn't prove the expenses were ordinary and necessary for his business. Without a business purpose, an expense is just personal spending. Maybe Spencer rented cars for family vacations. Maybe the repairs were for his personal vehicle. Without records, who knows? Ms. Schultz had a different problem. She was a teacher and sales consultant who claimed vehicle expenses. She had some records she could show where she went, but the court found her travel wasn't required by her employers. She chose to travel for personal convenience, not business necessity. Schultz thought any work-related travel was deductible, but the law is stricter than that. The travel must be required for your job or business. If you choose to drive to a conference when you could attend online, that's personal choice, not business necessity. Both cases teach the same lesson. You must prove two things. First, that you actually spent the money. Second, that the spending was required for your business. Receipts prove the first part. A detailed log proves the second part. Missing either part kills your deduction. Spencer had receipts but no business proof. Schultz had some records but no business necessity. Both lost everything. That's why it's important to work with a qualified tax professional. Click the link below to schedule a call with someone today. Because when taxpayers do everything right, they can win big. Let's see how it's done properly. Chapter 6, the Gonzalez case, how to win. Finally, a success story. Ms. Gonzalez lived 400 miles away from her side business in Southern California. That's an 8-hour round trip. She made numerous trips throughout the year to manage this business. The mileage added up fast. The IRS looked at her return and couldn't believe the numbers. They challenged her huge mileage deduction. This looks suspicious. Who drives 400 miles each way for business? She won. The tax court allowed her full deduction. Every mile, every penny. Now, the court records don't give us all the details of her mileage log, but we can figure out what she did right. For the court to approve such a large deduction for long-distance travel, her records must have been perfect. Her log was clearly contemporaneous, detailed, and credible. It documented the specific business purpose of each 400-mile trip. It created a believable story that matched her business operations. Maybe she had rental properties to inspect. Maybe she had a storefront to manage. Whatever it was, she proved it was necessary. Gonzalez proves the court isn't against large deductions. They're not trying to hurt taxpayers, they just want proof. Give them perfect records and they'll give you the deduction, even if the numbers seem crazy at first glance. But what happens when disaster strikes and you lose your records? Are you automatically doomed? Chapter 7, the Stewart case, when disaster strikes. Mr. Stewart was a musician who kept a perfect contemporaneous automobile log. He did everything right. He tracked every business trip. He recorded all the required details. His records were flawless. Then disaster struck. His house burned down. His log was destroyed in the fire. All his hard work went up in smoke. Most taxpayers would panic. They'd assume the deduction was lost forever. But Stewart didn't give up. The tax court still allowed his deduction. This case shows there is a narrow exception to the strict record-keeping rule. When records are lost due to circumstances beyond your control, like fire, flood, or theft, you can reconstruct them. But this exception is very limited. You must have credible evidence to back up your reconstruction. In Stewart's case, his overall credibility was the key to victory. The court believed his testimony about the destroyed records. He could describe his lost log in detail. He could explain his business travel patterns, and he had other evidence that supported his story. This exception only works for true disasters. It doesn't help taxpayers who never kept records in the first place like Kilpatrick. It doesn't help taxpayers who created fake records like Ez. You must have actually kept good records that were genuinely lost. Don't plan on using this exception. Plan on keeping perfect records and backing them up. Store copies in the cloud. Email logs to yourself. Print important documents. Protect your records like they're worth thousands of dollars, because they are. These cases show us the stakes are high, but victory is possible with the right approach. Let's put together everything we've learned. The bottom line, the taxpayers in these cases learned expensive lessons. Craddock learned that incomplete logs fail. Kilpatrick learned that timing is everything. Ease learned that fake records backfire. Spencer and Schultz learned that business purpose matters. Gonzalez showed us that perfect records win. Stewart proved that even disasters can be overcome with credibility. Vehicle deductions are valuable. For 2025, every business mile is worth 70 cents. That adds up fast, but only if you can prove those miles in court. Follow these lessons and your vehicle deduction will survive any audit. Ignore them and you might become the next cautionary tale in tax court. But there are other mistakes you need to be aware of if you own an LLC. Coming up next, I have a video on LLC mistakes business owners must avoid, so check that out if you haven't already. As always, thanks for watching and I'll see you in my next video.